Raphael Douady. Welcome to the channel. I'm really excited to have you on.
Thank you.
So, just a quick introduction from my knowledge. I mean, the real purpose of this is just to bring you on, learn about your background. I've been following you on LinkedIn for some time, and then some introductions of ours came into play here. But you're a mathematician, an economist, an academic, a practitioner. What is kind of like your pitch? Like, what is who are you, and kind of like just at a high level here?
One of my jokes is that I'm schizophrenic by three axes. One, indeed, as you said, is math on the one hand, finance, economics, I mean, whatever is social science on the other one.
Right.
Another one is, yeah, business and academic. And the third one is the Atlantic, I mean, Europe and the US. In some way, well, if I have a pride, it's the one of building bridges between things that are pretty hard to make compatible. And in every case, I remember when Jim Simons passed away, no, yeah, they pulled out an interview of him that he did, of course, when he was still here. And he was proud to say, I'm seen as a mathematician by business people, and I'm seen as a business mind by mathematicians. And the truth is the opposite. And I told to his wife, who is saying that, and that's also what I try to be, that mathematicians saw Jim as a mathematician, and finance, I mean, hedge fund managers saw him as a hedge fund manager. So he was excelling in both cases. It's not like, people who appear, as being mathematician to non-mathematician because they know some math a bit more than the average person,
Yeah.
and who seem to be businessmen to the mathematicians because they know a bit of business enough to impress a mathematician. But you have few people who excel in both cases.
It's very hard to do. I can tell you that.
I can tell you by experience, it's like having several brains. I don't know, people who are born multilingual. That's the case of my wife. She educated our two daughters. My grandkids now live between London. I mean, they live in London, but their both parents are French. They are true bilingual, French and English. And I see, the brain switching from one to the other. And sometimes they think like French people.
Hmm.
And and you have to do that. When I speak to people, to people who are good quants, who tell me, well, there are this and this on financial markets, I can play that. And then immediately it's my trader character that comes out and says, don't dream of it. It will never work. The market don't work this way, you know. And it's not the mathematician who answers the other guy who is a quant. It's the trader. It's like Nassim precisely, would answer, like he answered me so many times. It's like suddenly it's the immediate. So yeah, they after some time, you start developing this multiple brain who intuitively reacts before even thinking, before analyzing.
So, how did you get down that path? I mean, right, let's go way back. Like when you were a kid growing up, did you always want to be a mathematician or an economist or like what was kind of that process?
Well, first economist, certainly not.
Yeah.
And it's more for visibility and, comprehension from the public that I name myself economist, but I don't consider myself economist. But it turns out that every time I think economy, I feel like I'm more in the truth than most of the economists I know. So I mean, yeah, you see, economists essentially, they apply their own logic, their own models, etc. They are pretty far away from reality. And so, yeah, if I think economy, I think, like someone who really is ready to invest in what you think of. So if your model is telling crap, I saw recently there was you know, um, a disagreement. Economists were seeing a recession coming, and financial analysts were seeing, the financial results of company growing, etc. And then people were saying, well, there is a disagreement. And even though I tend to be pessimistic by nature, I tend to be a bit of a Cassandra, who will announce a crisis, etc. So uh, my my gut tendency would be to be pessimistic.
Hmm.
I don't know whether I'm right or wrong, but when I see financial analysts saying something and economists saying something else, I'm not discarding one or the other. And I've seen financial analysts completely dreaming, being, you know, fooling themselves in their over optimism, which is possibly the case. But one are in the market and the other are not in the market. The one feels it. I mean, you see, and that's something you have to develop when you're a mathematician because, yeah. So how to tell? As a kid, you're joking. Exactly. That's exactly it. You got it perfectly. Um, I wanted to be a mathematician because my father, a mathematician, he had been a fireman. I would have wanted to be a fireman. I mean, uh, but at the same time, it's more subtle because first, our family is very scientific. My father is this very interesting scientific kind of, kind of scientific who, on the one hand, was a pillar of Bourbaki, extremely abstract, uh, but with deep geometric vision and geometry. When I speak geometry at this level, we're not talking of a triangle, and we are talking of very broad spaces that you build the Grothendieck type. And he was very close to Grothendieck, and so we're at that level of mathematics. And so, of course, when I was a kid, it was completely ununderstandable to me. It's like, it was totally, I mean, it's a different language. I was not able to follow. However, I always found math at school extremely easy. I think just only one time in all my scholarship that I didn't have the maximum grade. Mhm. And I was in primary school. Uh, and the and my father told me once, I was an adult, that when I was a kid, he detected a tendency to be too abstract. And I remember that he was bringing me to the forest. We had a family in the center of France, in the middle of the woods. And so he was taking me, observing animals, plants in detail, and he told me, I detected something that only a mathematician could have detected because it was the same thing he had probably, that I had a tendency to abstract nonsense reasoning, and he said I had to put your feet on earth. And so, yeah, that was probably something, like on those families of musicians, like, the Shostakovich, where they are musicians, grandfather, son, or the Esa-Pekka Salonen, and these kind of, where you have, uh, except that I would say that the music is an art. It's something. It's a feeling. It creates an atmosphere at home. Math is very, how do you say in English, arid, very dry.
Hmm.
Mhm. And the fact that you transmit math to your children shows a very uh, deep, um, there is a passion here. There is a passion for observation, that goes way beyond math. Something that goes to physics, to now it was staying in the range of to biology, etc. My father was extremely good both in physics and biology. He was extremely knowledgeable. Um, had a passion for that. My wife is a medical doctor. She was when she was studying because medical studies go pretty long,
Yeah.
and he was uh, with her looking at the big array that she did, on the chemistry within the body, etc., trying to understand the harmonic mechanism, etc. No, he was absolutely passionate, and he transmitted this passion.
Okay.
So if there is something, that's where you can see it. Then yeah, math was, yeah, in some way I was talented. Yeah, sure. Um, then I was bragging that it was all coming easy and I was not working. The reality is ask Ralph Nadal or Federer, how much, or Djokovic, how much they work to be on the top. I mean, especially when you are good,
Yeah.
you have to work like crazy to be on the top. So I did work like crazy, but I like.
Is there a part where you like fell in love with? Because I know you started in pure mathematics, correct? Is there like a topic or an area that just really kind of sucked you in that really made you want to go towards the mathematics?
Well, all my PhD, etc., were in dynamical systems. So that the area which in common language we call chaos theory and all those things. And that actually marked my appreciation of math finance because most of people in math finance are come from probability, and so they see moves as um, random walk, etc. Like if there was some god who was throwing dice and telling you, I never saw like that. It was always for me the complex dynamic of a system, like the weather, like so there is some randomness that emerge and it's there, but at sometimes you get crises, etc. So I whatever the probabilistic approach is for me only an interpretation of an emerging behavior, but the reality is more of a complex, highly dimensional dynamic because that's my bread and butter.
Okay. Do you think there is a generalized system behind it, or do you think it's more of a dynamic?
That's a very difficult question. That's a very good difficult, and I thought one of the things that I've been trying to address is whether there is true randomness
Mhm.
or it just emerging apparent randomness from behavior that if you had all the information up to the entire life that would bring a trader to make a decision, you would be able to know what would happen in markets. I don't think anyone has the answer to that because the amount of information you would need is so infinite
Yeah.
that it's beyond any type of so the random approach is perfectly legit, even scientifically. Now, whether they true randomness, that's much more complicated because that means that can you say that every decision we make, every decision you make, I make, etc., are random or are deterministic? People will tell you, yeah, we are quantum, we are driven by quantum mechanics, so there is a Heisenberg uncertainty principles as there is randomness. But it's even more complicated than that because we truly have, um, the free will.
Mhm.
Uh, at some point, you decide to do something, and you say, "Well, I could have decided to do the opposite." So there is something in you that decides, that makes a decision of buying or selling, if it's financial market, but even on anything, to give a phone call, to act in any manner. Uh, Everything that does our personality, our shame, our pride, is a decision which comes from something that we call I. And that I, nobody knows what it is.
Yeah.
Uh, so is beyond the question of randomness. Mm. So whether now Of course, when you have millions of or thousands of traders that push the market up or down, uh, we are beyond, the individual free will. But if you ask if there is true randomness, that would mean that we would examine the free will of every single trader. So it's impossible to answer that question.
Yeah. Do you think that's the advantage though, the mathematical thinking, right? The abstraction. Like we don't always necessarily need to know like an exact numeric number for it, but it's understanding it more at a abstract level of kind of a system and a process and kind of how things move together.
Yeah, no, that's why you do math. I mean, the math here, there's this famous joke, of John Box, all models are wrong, but some are useful.
Yeah.
And the question is, what's the difference between a useful model and a useless model? And uh, I would say that the useful model, all models will be approximations. There is nothing that will describe the reality up to the end, just what we discussed. Mhm. So all models will be approximations, will be something, that says, okay, let me grab the most important variables. Mhm. And if randomness is the model, that means that what kind of randomness, what volatility, etc. So we will apply a model and appreciate, and a model that is useful, it's a model where if we are slightly wrong, it doesn't lead you to a complete different decision.
Hmm.
If you have a wrong, if you have a wrong estimation of volatility, your price of the bid that you are going to do, or the ask for an option, will move slightly, but it won't jump completely.
Yeah.
Or it won't make you, suddenly, or I mean, they always, critical points where at some point a slight move will make you completely change your view and change the model. And that's interesting that we go here in another question called self-organized criticality. But in general, a useful model is a model where you know that you are going to be wrong, you know that you are going to trigger the thing, and that may adjust, your decision, but not make a radical change in it.
Right. Yeah. Model stability has been one of those things I've chased career-wise, but I think it's
Yeah.
often overlooked as we, get too excited about accuracy. That seems like the hype and the buzz. We're all chasing the accuracy. And working in the banks for so long, I'm like, no, 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 we want robust stability. So we have some sort of predictability of when things do go wrong, we know about what we're going to get.
In my early years as a quant in banks, so yeah, we can go back to how I shifted, from pure math to applied in general and more particularly in finance. But in my early years, I remember that I was totally unable to answer a trader, here is the model, without saying it's valid within this range.
Yeah.
And the trader was systematically answering, I don't care that one, just want the formula. Please give me the formula.
Yes.
Range
I,
is my problem, it's not your problem. I say, well, okay, but and it was, something. I mean, I haven't changed on that aspect. I'm still unable to consider something, where I don't permanently validate that that's the correct model and that we should do something else. But the inability to, I know so many quants who precisely would give, oh, if they want the formula, here's a formula. Hmm.
yes.
And I educate my own students. You see, that's where, on the one hand, that I can't prevent. I'm an educator. I'm also, my father, I was just telling you, was a fantastic educator, and I'm myself an educator. And I have students, and I tell them to evaluate the validity of their. I teach them to do that because I would not know how to assess a model without making sure that it's the right tool for that particular question.
Yes. I face that constantly. I get to the business, I say, I need your use case. Tell me what you're using it for. And then to your point, they go, no, 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 just give me the price. Just tell me what the pricing formula is. And I'm like, but it's only valid within these conditions. And trying to get to the details on that is always challenging. So you went into pure mathematics, right? It seems like this is kind of ingrained in you. It's part of the family. What point made you go more towards the applied math side and then kind of segueing into quant finance?
My life is everything but linear. It's a sequence of brutal changes. Um, I was once, very brilliant mathematician, and I could have gone on, uh, right, like I was on the track in the rocket uh, I proved, I mean, I had a fantastic year in 87, 86, sorry. I proved a major theorem. I wrote a big book on Hamiltonian dynamics on symplectic geometry. It was pretty tough. I was about to start a second book that was more related to that major theorem that I proved. And I remember I had a physical need for a break.
Okay.
Uh, I was 26 years old. I had the all the time, the limit for Fields Medal was 40 years old. I was really on that track. Um, and I had a physical need for a break. And I went to work as an engineer in the space industry.
That's a very
Yeah,
interesting shift. I think math
yeah, no, no,
is going into the engineering side.
I mean, yeah, it's there's really need for concrete things. And
Hmm.
it was funny because uh, they told me that I was a bit of a special animal because through my education, I had, this. My father was very good at giving, the common sense, the commons engineering sense. Uh, Add to that, when I was a teenager, I was passionate with modeling, making little planes, etc., that were flying. And that when you look at it, it's pretty difficult physics. Yeah, there was this sense, even as a student, I was buying cars, like wreckage, and I was undoing them up to the last bolt and rebuilding them. So yeah, there was this kind of handy things together with the abstract math. So it was kind of natural to go to here. I learned a lot. I discovered everything about control theory, which I didn't do much in my research. There was some difficult things. I mean, at that time, it was not so easy. We didn't have the means, and there was, for space rendezvous, there was the matrix that I mean, today we get images that are millions of pixels. At that time, it was 16 by 16, 256 pixels. And you had to locate things using control theory at about a tenth of a pixel.
Okay.
So it's like beating the Heisenberg inequality. Mm.
Very interesting.
So that was a game, and I'm talking of normal engineers. They were not Fields medalists, they were just good. Mm. And and then at some point, the surprise to me was the reaction of the math community who rejected me like they were admiring me before. So I noticed, I was not prepared for that. I was in my world, I was doing what I thought was good, etc. And the French community, it's like, oh, he left math, he's not one of ours. What's wrong with you guys? I've been with you all the time. And it became even worse when after, the company I was working with had some financial difficulties and I switched. And then there was a friend trader who called me saying, okay, well, let's come over to Societe Generale. And same thing, I told him, you're crazy. Don't have a single clue of what financial market is. And then I remember the head of capital markets who told me was in the you see, I mean, you're in a hiring context. You need money. Just had a little baby at the time. Um, And so I knew I needed the job. And I was telling the guy, but I don't have a clue of financial markets. That's okay. We need your math. We'll teach you financial markets. And they did. I mean, that's, it was very, well, and then, yeah, the good thing, at least, I don't know whether I am particular as a mathematician or all good mathematicians are like that, but I had absolutely zero a priori.
Hmm.
If people are telling me, okay, well, let's optimize that, and so, no, this doesn't help me, etc. Okay, if it doesn't help you, let me try to understand why it doesn't help you. I was never in the idea of imposing any type of model to people. And people who are doing so were, I was calling them professor of finance, and they're pretending they were mathematicians. For me, they were not because I knew what a mathematician is. I
Yes.
don't have the same level of reference. The ones I knew, they were Bourbaki, Fields medalists, etc. Mm. So, so they were pretending that they had the level of a good master student, but that the people who you see, written books become famous, and those people were had this mentality of imposing, this is my model, this is the model you should apply, etc. And I was very shocked because that wasn't my approach at all.
Hmm. I could see that. Did you ever did you ever run into Fisher Black? I know coming from mathematics background.
So unfortunately, Fisher Black, I never met him. He passed away before I met him. I still know very well Bob Merton and Myron Scholes. I knew Mandelbrot since I am a child because he was a friend of my father. And so that's a very different kind of thing. When I decided to go to New York, it was Marco Avellaneda who invited me to actually to he had. I knew when I studied at SocGen that I had no clue of financial math, so
Yeah.
I decided to start a seminar to learn myself. And I started a seminar that still exists at Institut Henri Poincaré here, the Bachelet seminar every Friday morning. It's still there, same Friday morning. And I was the one who initiated it 30 years ago.
Wow.
Um, and I called Nicole El Karoui. Nicole, I have this idea. What do you think? Okay, yeah, that's great. And she was very enthusiastic, very helpful. And then I invited Marco as a speaker.
Hmm.
And after he gave his talk, he said, "We need this conference, this kind of of a weekly seminar in New York.
Yes.
So next September, if you're okay, you come to New York at NYU, you teach there, and then so that's how it started. And then we organized this seminar every Thursday evening, where actually Nassim was the perturbator. So he
Okay.
was there every Thursday and was making the hard life to the speaker every single Thursday. Um,
Is it open to the public or is it like a closed group of?
yeah, no, that was no, precisely. It was we had all the quants of New York. It was the meeting of all the quants of New York. And same thing in Paris, people are supposed to be confidential. They were in the room. Suddenly in Paris, you get people from, Crédit Lyonnais and SocGen and BNP. Oh, I have this difficulty. How to, oh, let me to help you solve it, etc. You saw people who were supposed to be in competition suddenly being, very cooperative. And
Yeah.
the same thing happened in New York. It was we had people from all the banks, and they were all coming to the seminar and exchanging like completely freely. And so this seminar, there has always been a seminar that was the meeting for quants in New York. After this one, it was a BlackRock seminar run by Marco and Rama. And then now it's more of the Bruno seminar at Bloomberg, the BBQ,
Okay.
uh, who is where you get again, all the quants get together and gather together. It's a bit different. There is more people. It's more social, a bit less friendly as we used to do it at NYU, but the same idea is still there. So we did that. And when I went to New York, my father told me, oh, if you go to finance, there is this guy at Stony Brook. You should meet him. His name is Jim Simons. And because for me, Jim was a mathematician. Actually, the reality is that there is a guy who is, how to put it, almost an uncle to me, Dennis Sullivan. Dennis is Abel Price now. He was a very close collaborator of my father. He was visiting Paris. He went to AHES. He was visiting Paris on a very frequent basis. So I knew him again since I'm a child. And Jim and Dennis are very close also at Stony Brook.
Okay.
So through Dennis, my father knew Jim. Yet when my father passed away and I called Jim to tell him the bad news, and then he said to me, Raphael, I'm very sad for that. I must tell you something. I know you much better than I knew your father. So
So did you end up growing a relationship with him just from being in that New York kind of quantitative finance realm as well as kind of having those math ties?
the thing that made a radical change was the start of his data.
Okay.
So I mean, look, if I'm just telling you, the radical change, what they were. Uh, First entering Ecole Normale and being on the like on the rocket trail, to Fields Medal. Then you turn, I mean, no, 90 degrees turn going to space industry.
Mhm.
Another 90-degree turn going to finance at SocGen, but more on the sell side.
Okay.
Mhm. Was yeah. And then among the different things that I was asked to do, I went to SocGen, CIBC, I was working for Murex. And at some point, a guy who used to work with Nassim long ago had a demand from the Paris Stock Exchange to analyze that data. And the last question was advise us for a risk software for the exchange when they wanted to merge before doing even Euronext to do Paris Bourse. That was a merger of Société des Bourses Françaises, Monep and Matif.
Mhm.
And they wanted to get risk figures to be able, to put weights to the three entities.
Okay.
And of course, an exchange doesn't have the classical risk of a bank. You cannot calculate a value at risk based on volatility. They are just putting people together. So the risk is only an extreme risk, something that when it goes beyond and there is a default on the margin, and this is the level of risk. So in the essence, it was a problem of simulating financial market with fat tails, because without fat tails, it makes no sense. And they had mass of data to analyze, and they gave it to KPMG, who gave it to those guys who were former partners of KPMG, because they were traders, and they were completely submerged with the data. They were completely disorganized. You get time series with codes, had no clue whether it was a bond, a warrant, or a stock, etc. And they were incomplete and they were etc. And I remember we worked for about 3 months, day and night. So I was working the day at CIBC. The guy was in New York. I was meeting him at 6 p.m. and working until 2 a.m. I was sleeping on the daytime. And in the end, we had a meeting with the CEO of Paris Bourse.
Mhm.
And I had called all my friends who had, sold the Murex, algorithmics, etc. All the guys who were friends of mine, people I had invited to speak in the seminar, etc. And then I told them, okay, well, this part of French exchange is asking for a software. How much you would charge? And I saw the figures, and I had a completely crazy, irresponsible reaction to Jean-François Théodore. I told him, well, take the lowest one. They seem big to me. Take the lowest one, divide by two, and I do it for you. But uh, I will do it for you, but I want to start a company upon that. So you help me starting my company. And Theodore reacted, oh, I love that idea. Yes, go ahead, Raphael. And
Give us a
that's
bunch
how
of
we
money.
started with data. So you see, I mean, it's a sequence of things like this that were, then we start with data. It was 99. we start trying to raise money, and in 2000 you get the bubble burst. It
Mhm.
was impossible to speak to investors, etc. And the second thing that killed us, it was 9/11.
Oh,
By
okay.
chance, we found an investor who started to put a little check in July of 2001, and
Uh-huh.
he was supposed to be followed 3 or 4 months later by a bigger check. But because of 9/11, we never saw the bigger check. So we had to, to starve. And then he was a friend of us who had a fund of hedge fund in France and who told us, guys, I have a problem. If you can answer that problem, I save your company. I will buy your software and I will make sure that all my friends buy your software as well. And
Okay.
he did it. He really did it. The guy was absolutely fantastic. And he said, okay, my problem is the following. I am invested in about 100 funds and I'm meeting, I don't know, north of 200 managers per year. That means that, I'm meeting I'm having several manager meeting per day. And you think that I'm talking to investors to invest? No, I'm talking to managers to choose them. Mhm.
Okay.
And my problem is that they are all good people. I mean, the majority are very good people. They are very clever, but they can be blind on their own risks. They give me performances which are, these are audited. I can trust that. Everything they tell me, I have to double check. So I cannot trust it.
Yeah.
Uh, and so, what can you say if I simply give you a sequence of performance? No portfolio composition, nothing, no other information. Hmm. And I tell him, okay, I'll have to sit down next to you because that's something I've never done. And I have to understand how you reason to put that into the math.
Yeah.
Okay,
Exactly.
you're welcome. And I spent hours sitting next to him. There was Bernard Lozé. I spent hours speaking next to him, sitting next to him like a kibitz. My mouth was shut and I was just observing. And then I was telling him, that's interesting. You spend 5 minutes talking about sharp volatility, correlation, etc. And you spend the rest of the hour what happened in January of last year when all your peers were losing money? How did you manage the turn of the market? How did you blah, 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 etc. You were talking about specific events.
Mhm.
And that was most of your discussion was about specific event. Yeah, that's where things happen. Okay, that means that if my math don't naturally, I'm not talking of forcing it and telling them here's the specific events. If the math has to automatically focus on those events, otherwise I'm missing the point. Yeah, you got it. And then it was, and that's how this polymodal theory came up. Mhm.
Okay.
Why? Because there was non-linearities, especially when correlation were changing, where every single event was always marked by something in the market that moved more than the rest. Mhm. There was always something, but it could come from anything. And you never knew what was the thing. So I had to monitor many, many, many factors, monitor the impact of every abnormal move and that's how I came up with this polymodal theory. I didn't call it polymodal at that time, but yeah.
So exactly what is a poly model? I know you have a textbook, so I'm like looking at it online and I'm like,
No,
okay,
no, yeah. To make it short, people tend to analyze phones by multi-factor analysis.
okay,
Even though they have some good tools, they can have 50, 100 factors, and then select the 4 or 5 factors that matter for every single phone. There are two caveats. The first one is that to make a multilinear regression, you completely rely on correlations.
Hmm.
Correlation between the fund and the different factors, correlation between the factors, and the math formula to get the coefficients has to take the covariance matrix of the factors and take the inverse of that covariance matrix. Um, so that means that this matrix is not stable. If it's too big, it will have collinearity, the inverse will be very unstable, etc. So the coefficient, if they are unstable, they don't have any good prediction value. To have prediction value, they have to be stable.
So this is essentially a stationarity problem, right? Because the distributions of those are not stable across.
No, it's also a numerical problem
Okay.
because if the result is unstable, that means that even if it's stationary but slightly fluctuating, then we reach that problem that I was telling you, that the 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 consequence on the coefficient is so big
Okay.
that the model precisely on that sense that we are talking earlier is useless.
Yeah.
So you get this problem of model instability. The second problem is uh, we have some offers that I see, today for people who do software to analyze fonts, that two different fonts will not be analyzed by the same set of factors.
Hmm.
If you have a relative value, if you have long short equity, if you have an emerging market, you need to have factors that are specific to those markets. Otherwise, you miss the point. Mhm.
Yeah, makes sense.
But now, when you get a portfolio, how do you assess the diversification of this portfolio? How do you assess the fact that the portfolio can be, seemingly uncorrelated, but if there is a large event, suddenly it will become very correlated, etc. So how can you address the optimize your portfolio or simply allocate or simply you meet a new manager, you like the manager, but you wouldn't like him to increase the risk that you already have. You would like him to be, kind of, not, I mean, be a new direction of risk so that it does not it add in an uncorrelated manner to the rest of your portfolio.
Hmm.
Mhm. And or at least you to assess, by how much it is that the essence and this risk contribution is the essence of portfolio construction. If you have one fund that is described by a certain set of factors and your portfolio, all the other funds are described by other sets of factors, there is no possibility to aggregate the whole thing at the level of the portfolio. You're blind. It's like putting together, teaching a class where you get a Japanese guy, but he doesn't speak only Japanese, a German guy only speaks German, and an Italian guy only speaks Italian. I mean, if you're not yourself completely polyglot, there is no way you can. Mhm. And you need to find a common language. And that common language, if it turns out that the Japanese guy speaks three words of English and the Italian guy speaks three other words of English, which are not the same, it's about that.
Okay.
Mhm.
So how do you, is it like generally mathematically, are you just trying?
So what we did was to put the nonlinearity first and the multifactor behind.
Okay.
So to say, okay, if nonlinearity is important, I can assess nonlinearity with respect to one single factor, not with respect to a mix of factors.
Okay.
And I can assess what I call the beta plus, the beta minus, the extreme. It's not, the impact of a drop of the market, of 5% or 10% is beyond 5%. What is the cost of every single percent of the market? That's what I call the real beta minus. Same thing on the beta plus. Mhm.
Okay.
Now, those things are perfectly aggregatable. They correspond to scenarios in the market. And you get, the global risk and the global contribution to risk of every single fund with no surprise on correlation because you have integrated the change of correlation and the large moves.
Okay.
So if I want to say it, my way to summarize is people have no clue of the richness of math. Math are extremely rich. And once you understand the problem, there will be a math solution to it. but you have to think out of the box. You permanently have to think, okay, what is the problem? What did he? I hate, going billiard three, band, etc. If I have a target, I go directly to the target.
How do you get people to understand that? So I'll tell you, I'm a outsider looking in. So I studied finance, econometrics, went into statistics, probability theory, the traditional path. And then it wasn't until later I realized I just like reading math for math. Like I don't care about anything else. I love Gill Strang's
That's good. That's
linear
good.
algebra book.
Now, math should be studied for math.
I don't know how to convey that to people though. Like it's interest. I read it and it's interesting, but then to your point, it changes the way.
Let me make a daring character, a daring parallel.
Okay.
You study music because you like music. Turns out that if you're a good musician, you will seduce girls and then you will get some success, etc. Hmm? But you don't study music to seduce girls. You just study music because you like it.
Yes.
And you will never seduce girls if you're not good at music because you like it. You'll be a false fake musician and that will be visible.
I think that's the problem with finance. So when I look around, I see too many people that are excited about the money. And then they look at us like I build quant teams and they go, why did you hire this mathematician? It's a topology PhD. It makes no sense. And I'm like, because they love the math and solving the problems. And we're here to solve the problems. I'm not here to make the money. Like you guys can worry about the money part, but I was like, bring me an interesting problem to solve. Don't focus on how many dollars we can churn with it.
Yeah, that's the difficulty. At some point, building the corporation, because I mean, a good trader is greedy. If it's like, I have maybe an unorthodox opinion on, for instance, stories like Kerviel or Barings. What was the name of the Barings? Nicholas. Anyway, doesn't matter. Uh, okay, the guys misbehaved. There is no question.
Hmm.
Whether it's Kerviel or this guy at Barings or other like that, they were rogue traders. They misbehaved.
Hmm.
Uh, but my view is they've been hired because of their temperament.
Okay.
Because if you want to make money on financial markets, you need to have lions, not a sheep. Mhm. Now, once you hire a lion, you put in place whatever it is to monitor the lion. And every dompter will tell you at the same time, I have to have control. I have to let him act as a lion. Otherwise, I won't get the benefit. You cannot expect the benefit of of a horse, winning all the races and force the horse to behave like a baby. No, you have to let the horse express himself. But at the same time, you have to put the controls in place so that you keep control permanently, and that's a permanent subtle relationship with the thing. And in here, there is no question. I mean, a good trader is greedy. If he's not greedy, take another job, be a baker, whatever. Mm. A mathematician is passionate with his math. He will be always thinking of models that make no sense. That's like that because you cannot force a mathematician to only talk about things that make sense because otherwise you're kind of framing his thinking. You have to let this imagination express itself. Now, how to have those two people talk together and and find a way, with one, and they are both brutal in their way, so they shouldn't be surprised when they're there, when they when they say you're totally stupid, and the one day you don't understand anything, etc. And that will happen automatically if they are good. If they are good, it will happen. You cannot expect anything else.
I mean, how do you encourage those to pursue math for the ability of that, like in the business? How do you get them to
It's
understand that?
difficult. It's difficult. The math, that's why I was comparing to music. You're transmitting a passion.
Okay.
And it works, it doesn't work, it comes from childhood. The one single professor in all your scholarship can give you the passion. Another profession can kill your passion. uh, it's very difficult. I tend to believe that kids are born completely multi-talented. They are painters, they are musicians, they are poets, they are mathematicians, they are scientists. They observe, they are fascinating. they are everything. Uh, and the only thing that happens is that you start losing all those talents. And the duty of the parents is to try to keep at least one of those talents, so that the person keeps one talent and at the but I'm not saying that all parents are like that, but that's how I think, you should do the kids until puberty. You will be amazed by the creativity, the beauty of what kids are able to produce.
Yeah.
It's absolutely incredible. Puberty, that's true. It's a big break. Suddenly, they think of the other gender and then they're completely obsessed, and then all this intelligence drops completely.
Yeah.
Mm.
I've got a 1-year-old and a 5-year-old, and it's very eye-opening. Like she sees something like she'll see like a ladybug on a piece of grass or a flower, and she's just amazed by it. And
Yeah,
it
yeah,
reminds me, I'm like, there was a part of me that was so excited for that. It's nice to kind of see the refreshing world through like a 5-year-old
exactly,
eye.
exactly. It's the whole idea is, I think intelligence is about, among others, about keeping alive the kid that we have inside ourselves. Yeah.
Yeah. All right, so one final question here. You're doing an AI presentation here with Wall Street Scholars. Do you want to
Yes.
give me a little bit of like what you're going to be presenting, talking about?
Well,
I was excited because the topics were new.
yeah. So AI was the new, and that was not due to me. I mean, it came like an elephant in a China store. Uh, for science, you see, I mean, people are talking about rigor, etc., and then suddenly you get this thing that comes in, and for a mathematician, for a scientist, for a data, I think the word data scientist is very overused.
Mhm.
Uh, we have an expression in French. I don't know how you say it in English. We say a word suitcase, a suitcase word means that can mean anything.
Yeah.
And I understand people who say on their CV that they are data scientists because that's a way to sell your CV. Uh, Now, for me, there is a meaning to the word scientist. So I cannot claim that someone who knows a bit of programming is a scientist. It's just a good engineer. And I have no denial for what they do. I wouldn't call it this way, but it turns out that the way people call it. I've seen headhunters telling me, Raphael, so, oh, your CV says, okay, well, that and that and that. But did you do any data science? And I look at the headhunter and say, do you know what data science is? Yeah, well, so you don't see on my CV that I've been doing data science for 30 years?
It's a good point.
And it's the gap, so people have they put a word now. Now the reality, yeah, it's this story of understanding data. When I was telling you, I'm giving you data and you have to tell me what the guy is doing, what his strategy, what are his risks, etc., out of nowhere, out just of a series of them. That is a data science problem. You
Yeah.
see, the the given data, and you have to find the story behind the data.
Hmm.
Mhm. In all its beauty. Mhm. So yeah, and then suddenly you get those neural networks. What are neural networks? My first reaction after I did all those polymodels, I discovered neural networks 2014, 2015. So pretty late compared to what they were, what pioneers were doing. Mhm.
Hmm.
Um, the grabbing the math that were monitoring them, even imagining different ways to improve them, was I was very well prepared. All my experience was, but so it didn't take me long to understand the whereabouts of it. But my first reaction was, oh, that's a different approach to doing nonlinear statistics,
Yeah.
because it precisely takes all the nonlinearities, um, and analyzes, the how data behave in non-linear manner, how they expose shapes, and what are shapes that tends to repeat, that tend to make sense, etc. And I was precisely very prepared for that. And my first reaction was this joke saying, okay, well, oh, I invented the stairs and now I get the elevator coming. Mhm. Because, yeah, you get all those, you didn't know what it do, but you see, if you look at polymodel, you will follow the story of every single factor one at a time. You will know exactly what's going on. You basically follow the path in machine learning. You get the starting point, the end point. You have no clue what's in the middle.
Yeah,
Mhm. That's why
exactly.
it really looks like an elevator with respect to a staircase.
Yeah,
Mhm.
definitely.
And so I liked it a lot, of course, because it was essentially nonlinear. Mhm.
Hmm.
At the same time, for me, it's still in infancy. It's still reproducing only a part, although, yeah, it's growing. It's growing. The AI of today is very different from the AI from 10 years ago. It's just completely different. Mhm. So what do we have? We have different breakthrough. The fact that you get adversarial learning, where the computer was trying to guess the defects of the other, the weaknesses of the other, and fool it, and the other had to react. So it's like, all nature is full of those things, of animals who fake that they are other animals. For instance, there are some frogs in Brazil, and they are, very brilliant yellow, the anti-camouflage, and they are very visible, and they're also very poisonous. And there are frogs who are not poisonous, but who develop the same color to frighten the birds. And the birds have developed this ability to distinguish one and the other. There is, you get in France, or we have those grass snakes and vipers,
Hmm.
and vipers are dangerous, and grass snakes are not dangerous. And so I was very much educated at making distinction between one and the other. And there is those what we call viperine grass snakes. They mimic, they have the V on the head like vipers, precisely so that birds be afraid of them. I would not catch them. Hmm? So you get this game, permanent game between aggressors and aggressees in nature. And if you want to have a good system that has not too much hallucinations, then it has to be trained against another system that will precisely target its weaknesses.
Okay.
And that's what they did. And then once you build that in a systematic manner and in iterated manner, you reach what we call reinforcement learning,
Hmm.
which is the dynamic thing, etc. And reinforcement learning is, it's made a big leap in the. At first glance, it looks like elementary because, I mean, when you do control theory, because it's just applying control theory to this nonlinear system that are neural networks. So, well, the math are a bit difficult, but you can, but the results are beyond the simple math. There is a gap. I mean, I've done a lot of Kalman filtering, which is the linear version of Bayesian statistics, and then you get those systems, that can integrate, the anticipation of change of regimes, etc. No,
Hmm.
it's every. I mean, is first it's difficult to follow all the new things. Uh, it's like, for me, it's a new science. Data science is a new science. It's neither math nor physics nor etc. It's a new science who have its experimenters, like in physics, the theoreticists, and of course, the good people tend to be both theoreticists and experimenters. I mean, as a theoretician, we receive new experiments that are made with huge means by those big companies, who on top of that tend to brag because it's business, so they have to overstate what they do really. Yeah, it's a fascinating period. It's absolutely a fascinating period.
Yeah. And so you're going to be presenting July 31st on some of these sort of topics and integrating them into finance. I mean, even like the hidden assumptions and data models and kind of the rare event detections were things that were like exciting to me. I'm looking forward to on that. Uh, just because as the discussion, right, we're having, it's looking at tail events, rare events, kind of your experience in control theory and looking for these anomalies. But then also, as we've talked about, right, looking for assumptions behind the models and making sure we understand where they actually function and work at.
So, okay, I could go in a bit into the techniques, but I will go into technicals during this presentation. But let me at least convey the philosophy.
Okay.
There is a tendency of people to say, let the data speak. We have no clue of what they do, so we only rely on the data, etc.
Yeah.
Surprisingly enough, I disagree with that.
Mhm.
And I don't disagree because I think we should have a prioris. I disagree because I know that we cannot not have a prioris. It's just impossible. And we better cope with that rather than putting that under the carpet and pretending that we let the data speak. Because if we let the data speak, that we only speak about what we see. And the reality, if, for instance, we talk about market regimes, etc. And you can analyze, 50 years of financial markets, find 10 different market regimes, where you switch from one to the other, etc. I can tell you what will happen next is an 11th one,
Yeah.
something you've never seen before. And it's only after a long time that you say, well, we never saw it, but finally I would put it in the category of this one that we've seen before, etc. And so that you get only after the fact will you be able to say, oh, finally it was more like this than like that. Mhm. But when it comes up, there is no way you can say, oh, we are back in this story. No. After 2008, I knew that there would be a crisis at some point. I spent 10 years trying to imagine what kind of crisis could come. And I was completely more in the mood of checking, political events, even wars, etc. The last thing I would have imagined, and I was stupid for that because I mean, first, my wife is a doctor, as telling you, etc. And I didn't imagine a pandemic. Hmm.
Yeah. A very, very rare event to be expecting.
It's not that. People have to invent something else. I knew it would be something else, but what it would be, it was not in the range of things that I had imagined. And you see that just to give you an example of, the kind of thing that I would put it this way. Whatever the set of data, however big is the set of data you're analyzing, any meaningful statistic that can do it comes with certain a prioris on the model. There is no way, and there even, I mean, I think I have a mathematical, I cannot even tell it conjecture because it's not expressed in a precise enough manner. But there is a principle in which I believe. I think believe is true. It's a bit like the Gödel incompletude theorem. It's said that precisely, yeah, if you don't frame the set of this class of distribution that you are considering, an infinite amount of data will never converge to one particular distribution. And the reason is that there will be always events that are rare enough so that you are not able to tell what is their frequency. So if you make the a priori assumption that you're in the Pareto distribution, you will find what is the thickness of your tails, etc. But you cannot absolutely confirm, even if you see something that really looks like Pareto, you
Mhm.
cannot absolutely confirm that the tails are Pareto. There could be something else. Mhm.
Right.
But it's a reasonable assumption to say they are Pareto, and therefore you can make a modeling using that, and you can have good surprises or bad surprises. Mhm. You see, and that's that's an essential point. Even when we do math, we cannot absolutely assert that a proof that looks rigorous is actually rigorous, and that's precisely Gödel incompletude theorem. The fact that a logical system is not complete. It cannot be assessed internally to itself. And in here, same thing, a set of data, however the amount of data, will never tell you up to the end what is the distribution. There will be always some shape in some particular characteristic of the distribution that you have set a priori, and they say, okay, I can estimate a parameter, but I cannot estimate freely, completely a class of distribution where I have no assumption on the shape. So what does that mean? That means that when we do, machine learning, etc., if you ask a system and give the system, a sequence, like I was telling, a sequence of data, and you ask whether the market will go up or down, whatever the system, it will tell you crap. Yeah. It will tell you. So if you ask a simple question to go up or down, you will hit a data wall, which is the efficient market hypothesis. If there is one thing that all those Nobel Prize of Economics, etc., invented that was a crap, there's one thing which is clever is the image. The only thing that I think is valid, and this one you can put any AI, any person, etc., in front of a market, and do you buy or do you sell?
Yeah.
You will never know. So the philosophy here is I'm not trying to tell whether you should buy or sell this asset, but let me try to find characteristics of these assets that makes it, more of a good trade or a bad trade. And that's why I do this polymodal analysis as a feature extraction. So if I'm telling you, okay, here's a history of this stock, would you buy or sell it? Even if you give, lots of history of lots of stocks so that you can evaluate the correlation, it will be very difficult. But if I'm telling you, okay, I made a pre-calculation telling me that this stock, here it reacts to this factor, here how it reacts to this factor, you will detect the convexities, etc. And there, the system can tell you, okay, given the stability or the instability of the market, this stock is a good trade, this one is a good buy, or this one a good sell, because of its relative characteristics to the environment.
Okay.
So you see, it's changing the paradigm from simply, going to raw historical data to prepared data, which are particularly those sensitivities to different risk factors. And that lets you, better grasp the behavior in the future with respect to a market of which you can estimate the characteristics.
Okay.
And don't imagine that a neural network will be more clever than our own brain, who needs to do those things before giving a recommendation. So these are, one of the things that I'm going to explain. Of course, I will try to address, the limitations, the consequence. Another thing, that a neural network, again, can give you, some prediction with some uncertainty. And the uncertainty can be asymmetric by two aspects. It can be asymmetric by saying, okay, well, I don't know about the upside, but the downside can go to that thing, or, because so your prediction itself can be skewed, but the impact on your portfolio also can be very asymmetric. So you can be much more exposed to an upside or to a downside. And you can be okay with a symmetric risk because you benefit more on the upside than you suffer from the downside, or the opposite. Particularly when you see a stock, that has asymmetric correlation with other stocks in your portfolio. So if there are low correlation on the upside and high correlation on the downside, then your exposure will be very asymmetric. And you will really need to control the downside because you are very exposed to the downside. Mhm. So this kind of thing is also the kind of answer that neural networks can bring in because they work in a nonlinear manner.
Okay. Would you use partial moments to estimate like the variance in the mean for like upside versus downside? And like Fishburne has done something similar.
You can it's you see it's things that give you, we have tools that are much more efficient. So those things give you information.
Hmm.
And they are very simple. So I would never discard simple things that give you, some a priori. But we get much more powerful tools that simply confirm what you already know. But they will be much more refined and accurate, etc.
Okay. Very interesting.
So we are going to speak of all that. Yeah.
Awesome. Well, Raphael, thank you for your time. I really appreciate you coming on.
Thank you, Dimitri, and so meeting you on the 31st for this event.